Hey, what's up, stock compounders? Brad here. So today I want to talk about a recent blog post from Chris Meyer, author of 100 Baggers, stocks that return 100 to 1 and how to find them, which is really a study of, over the last 5 decades, stocks that have returned 100 to 1. If you had invested $1,000, you'd have $100,000 in these companies, at least the potential for that. And I really appreciated his blog post, Reflections on 100 Baggers. So I wanted to share some of my highlights from that. I definitely recommend you subscribe to his newsletter. It's free. You just give him your email address, and then about once a week, he comes out with a new article, a new post, and I find them very valuable. So highly recommend checking that out. He's also really good at responding. If you get his blog post and you have a question, you just hit reply, and he's very accessible, which is awesome. All right, so let's go through this. Reflections on 100 Baggers. So his book is doing really well. It's been translated in multiple languages, and so he's doing interviews in those markets where the book is being translated. And so he has some thoughts that he wants to kind of updates to, what he would focus more on, what he would emphasize more if he were to write the book all over again today. So first question, do you think the next 100 bagger companies are mostly in the tech sector? Obviously, tech is a hot sector. The sector question he gets all the time, right? People want to know, where should I concentrate? Where should I focus if, I want to find these awesome long-term compounders? And Chris's answer to this, may surprise some of you. He doesn't think about industry, really. That's not how he narrows down his search for these 100 baggers. He points out, Google and Domino's Pizza both went public in 2004. How have they done since then? You might think Google has absolutely trounced virtually, at least the vast majority of companies, and it has. But you look at Domino's, and it's up, 29 times since 2004 versus Google, which is about 28 times. So, surprising, yes. Pizza seems very ordinary. It seems like it would be very difficult for any pizza company to compete with, a tech genius behemoth like Google, but clearly that's not the case. He talks about, if you look at the list of past 100 baggers, you see all kinds of industries. You got Campbell's Soup, Deere, Halliburton, Boeing, and the list goes on. Even if you look at the stocks that got to 100x fastest, you might think, well, certainly those have to be in the technology sector. It's not true. You get a mix of industries with no one industry really showing dominance with that. So, the recipe for 100 baggers is agnostic on industry. You can also see hints of that. I mentioned a study I think a couple weeks ago, and it was basically looking back at the last 5 years, companies that have returned, what was it? I think it was over like 45% a year for the last 5 years. And it's a study of companies all across the world, which was amazing, and it talks about, which sectors outperformed. I believe that healthcare companies and technology companies were high up on the list. But again, that's just 5 years. None of those were 100 baggers. I'll link to that study again. I know I've shared it with you guys before, but I'll also link to that in the description if you want to take a look. Right, let's see. Right, industry. Industry is really just a label. So what is tech? What is the technology industry, right? He talks about how, you've got companies that manufacture phones and companies that operate social media platforms are both lumped in to this technology sector. Well, how similar are those businesses? How useful is, you know, that classification in terms of the technology industry? And he goes a little further with that concept. He's a student of semantics. Chris Meyer is, and how humans really like to put labels on things. We like to put things in boxes, but that can actually be a dangerous thing to do. It can lead us astray. And he suggests here, well, why not? If we're going to lump all of these really different companies into a sector like technology, why not create an M sector? Every company that starts with the letter M, well, let's just lump all of those together. And then we can say, oh, the M sector made up X percent of the S&P 500. It's grown X amount. Anyway, he takes it to the extreme there. But, he says, don't put your focus on industries. It's really not an intelligent way to kind of parse out 100 baggers. So what is the key ingredient to a 100 bagger? Well, in his view, it's return on capital, right? That's the gin. And then you've got the ability to reinvest, right? Earnings, ability to reinvest, right? Cash flow, money that the company is generating. Can you reinvest that money to grow the company and earn the same return on capital on that money? Which, that's really the story of compounding, right? You start with your principal, and then you get interest the first year, and then you're reinvesting both that initial principal and that interest, and you're doing that over time, and you've got this exponential growth. And that's really all this is. It's, can you earn a lot on the capital, and can you reinvest it at that, similar high rate on, capital? That's the key. Now he talks about how return on capital is a bit of a vague term. There's a number of different things. You can look at return on invested capital, which is, kind of what the company is, like the net income divided by invested capital would be both the equity and the debt, right? You're taking those together. Return on capital employed, return on assets, return on equity. So there's all different flavors of return on capital. And how do you know which one to use? Well, it's really dependent on the business. What makes the most sense for the business that you're analyzing. Right, we want a really good business, and a really good business is one that generates a high return on the capital invested in it. Not just for the last year, right? That's why Phil Town, when he's looking at return on invested capital as a measure of how good management is, he's not just looking at the last year of return on invested capital. He's looking at the last 10 years. How does the 10-year average compare to the 7-year, compare to the 5, 3, 1-year average? And the hope is that it's going up as you get closer and closer to today. But you really want a return on invested capital that's strong, more than a year looking back, ideally 10 years or more. Right, he talks about how 100 baggerdom, it's a long and twisty road. The average 100 bagger over the last, in the study that Chris Meyer did over the last 5 decades or so, took 26 years to become a 100 bagger. And, it wasn't a smooth ride. There's a lot of hills and valleys. And because of those hills and valleys, there's very few investors that held on for that 26-year average road to 100 baggerdom. So that's a big challenge of getting 100 baggers in your portfolio is hanging on to them, right, through the volatile ride. You want a business that can crank out high returns year after year. You have to think about competition, growth potential, the ability to withstand economic cycles. So let's talk about the ability to reinvest. We've kind of talked about return on capital here. So what does it mean to be able to reinvest? You want a business that can take all of its profits and reinvest them back in the business and earn that high return on capital again on that reinvested capital, and do that over and over and over again. That's really hard to do in the real world. There's not that many companies that can do that. And there are things working against this effort of reinvesting at a high rate. You've got taxes, you've got capital expenditures, you've got a lot of companies pay dividends. So there's all of these ways that there's all these leaks, right? Where it cuts in to that compounding over the long term. So a great business has few leaks and can reinvest the highest percentage of the earnings that it's making each year, and earning the same high rate of return on those earnings. Right, companies pay dividends, they do acquisitions, they sit on cash, they blow the money building palatial headquarters. Again, there's so many ways that things that can disrupt this compound growth engine within these companies. Again, the two most important things: high return on capital, ability to reinvest. And then he mentions, stir that concoction into a coffee can and bury it. The coffee can approach. You're just putting your stock certificates in an old coffee can, you're burying it, and you're forgetting about it, right? For decades. That's the coffee can approach. Because you need that time. You need that time. The hidden third ingredient of a 100-bagger is time. Something that people have a really hard time with. As humans, we're so hardwired to do things quickly, right? Activity. You look at Warren Buffett, Charlie Munger. They, if there's one thing they've absolutely mastered, it's wait for the right opportunity to come along, and then sit on it, almost forget about it. It's such an important element of investing. So he says if he had to rewrite the book today, he'd spend more time emphasizing the 2 points of high return on capital and the ability to reinvest. What about valuation? People all the time ask him about valuation. It's important, right? You don't want to pay too much for a business. That it's much harder to earn an attractive rate of return if you pay too much. But it's not as important, according to Chris Meyer, as return on capital and the ability to reinvest. Right, he used to focus more on valuation. Now he focuses more on quality. Quality first, valuation second. That's something I'm trying to shift as well. Something Pabrai is trying to shift, right? Pabrai, his whole thing, the first 2.5 decades of his investing career was buy a dollar for 50 cents, right? Buy it for cheap. And that's a valuation question. Now, he wants to buy these companies that he could just hold on to. He doesn't have to trade in and out of these companies every couple of years. He wants the long-term compounders because he's really understanding how valuable that is over time to not have to really get that tax benefit. And obviously the longer you own a business, the more you understand it. So that's an edge as well of buying these things for the long term rather than moving in and out and having to, learn new companies all the time. Let's see. Right, you have to invest in a way that's compatible with who you are. Investing in a 100-bagger type framework might not be for everyone, and that's his point here. But if you're hunting for 100 baggers, if you're hunting for big game, you're taking a longer view. Those two are inseparable. He talks about Chuck Aker, who introduced him to the idea of 100 baggers. The book from Phelps, Stocks That Return 100 to 1, is the one that inspired Chris Meyer's book. So Chuck Aker has had 200 baggers in his career, right? He rarely sells anything, buys high quality businesses at good prices, and he waits, right? So that's really the formula here. So I just thought there was a lot of great insights in this article, like pretty much every article, blog post I read from Chris Meyer. So check him out if you haven't read 100 Baggers yet. Definitely check that one out as well. Like I mentioned, I will link to this study of great stocks, great companies globally over the last 5 years. And I actually sent that to Chris Meyer. He had already seen it, of course. I found out about it through the message board in Corner of Berkshire in Fairfax, which is another amazing resource that I recommend. But check out that study. It is very impressive. It's very thorough. And I believe it was just a summer project done by 3 interns at this investment shop. And it's really good. So I'm going to share that with you guys in the description. Anyway, that's all I have for today, guys. I will see you all in the next video. Take care.